Bonds are supposed to be the safest investment in your 60/40 portfolio, but recently, because of a lot of factors, including tariffs and increasing uncertainty about U.S. economic policies, bonds have become more volatile than usual, leading to the question, are bonds still safe to own in my portfolio? In order to answer that question, I'm going to teach you about how bonds actually work. Owning a bond is like loaning your money to a company or a government, and they have to pay you back with interest. You make healthy profits with stocks, but that stock market investment comes with risk and a lot of volatility. Bonds, on the other hand, are steady income producers that won't make you lose sleep at night, but they won't make you rich either. Bonds have two components, the price and the yield. And the price is what you pay for the bond, and the yield is the income it pays you, usually in percentage terms, like 4%, 5%, 6% as an example. The interesting thing is that the price and the yield have an inverse relationship. What I mean by that is as the price goes up, the yield goes down, and as the price goes down, the yield goes up. Kind of like this teeter-totter here. There's a whole lot more, but I like to keep things simple for you. So let me tell you what you all came here for. And what does all this mean for you, the investor? In May, the U.S. Treasury Department auctioned off bonds and the demand was low. Lower than the attendance at an Oakland A's game. Investors were skittish about buying because the proposed tax cuts from Congress would add trillions of dollars more to the national debt, making investors concerned about the U.S. government's ability to pay back the debt and remain solvent. Remember the simple economics lesson of supply and demand. When there's less demand, prices fall. They can't give those Oakland A's tickets away. And when the prices of bonds go down like they did last month, the yield goes up. In fact, the yield on a 20-year Treasury in May was north of 5%. In contrast, bond yields were only 1.22% back in the pandemic days. So 5% is a pretty good yield. Let me run you through an example. So let's say you use $5,000 of your Roth IRA to buy into a bond today at a good yield of 5%. That bond will pay out 5% or $250 a year for as long as you own it. So here's the strategy. If you own the bond and simply hold it until maturity, you'll get paid back all of your capital plus 5% per year. The only way you lose is if the issuing company or government goes out of business. Do you really think the U.S. is going to go bankrupt? No way. Not when they can change the tax code at will and tax the living daylights out of you and me. So should you own bonds? Yes. Buy the bond now and enjoy 5% income while you kick back and sip lemonade. Bottom line, while bond prices may have gone down, causing the media to claim that bonds are volatile and risky, tune out the noise. Look to buy high quality bonds with a nice yield and enjoy getting paid while you wait. Bonds should be part of a balanced portfolio for wise investors because they offer modest returns in exchange for a lot less volatility. They're kind of like an old t-shirt that you love. It's not fashionable on the city streets, but it's dang comfortable. If you're interested to know how much of your portfolio should be in bonds, give us a call or schedule a meeting with us using the link below. Or if you're near me in Carlsbad, Encinitas, or Oceanside, stop by our office. I'd love to see you in person. If you like content such as this, be sure to like the video, subscribe, and share this with someone who you think can benefit. Word of mouth really helps our channel grow. See you on the next one.